Good morning. Today is the 18th of October. It's Tuesday. Thank you for being here. We have some news on some companies from regulators that we're going to address first, and then we're going to talk a little bit about what's going on in the market, because this is an impressive rally and it looks like it's continuing today. So jumping into it, Meta is being forced to sell the Giphy app. This was an app that they purchased for $400 million back in 2020, but the UK watchdog is saying that they have to get rid of it, saying that the takeover of Giphy could allow Meta to limit other social media platforms' access to GIFs, making those sites less attractive to users and less competitive. It is also found the deal has removed Giphy as a potential challenger in the UK display advertising market, preventing UK businesses from benefiting from innovation in this market. The only way the sale can be addressed is by the sale of Giphy. This will promote innovation in digital advertising, et cetera, et cetera. So, Tom, it seems like it's not just the Biden administration that's going after competition, especially on software and advertising, but it's also the UK people.
Seems like they have bigger fish to fry at the moment, if we're being honest. I mean, I don't think it has it on here what date they bought it, but I remember
it was in 2020.
Yeah, so we announced it on the show. I remember talking about it on the morning briefing. So, I mean, I guess it's just a way for them to continue to prod these companies and potentially, I guess, extract more tax revenue at some point, or at least blame them for some of the downfalls of their economic policies. So, I mean, I'm not sure what comes from this. Can the UK compel them to sell Giphy if they're a multinational company, or do they just withdraw from the UK?
Meta accepts it. Meta has accepted it. It was a $400 million acquisition, but I think Meta will have the last laugh, because I think they're going to get a lot more than $400 million for it on a sale, even after all this. So I think it'll end up being a good deal for Meta. Obviously, they would like to have kept the business, but they'll probably take $1 billion to the bank, which isn't bad, to triple your money in 2 years. So not too bad for them. Microsoft is also under pressure to back away from the Activision deal from the UK regulators. They talk about PlayStation and Sony being under threat from Microsoft purchasing Activision, but Microsoft continues to say that the CMA's concerns are misplaced. So that'll be an interesting one to watch going forward. Also, we'll continue to watch the sale price of Giphy as that process commences now. The White House is planning an SPR announcement later this week. Even as the core inflation numbers continue to be elevated, they're looking to release another 10 to 15 million barrels of oil as part of the 180 million barrels that they announced 6 months ago. They've already done 165, so this would make sense. But importantly, they've also, in connection with this announcement, they're also going to provide details on plans to replenish the emergency stockpile. I think this will be inflationary, because what are they going to do? They're going to say, we're going to finish out our what we've already said is going to happen. And also we're going to start, not only are we not going to be releasing, but we're going to start buying. It seems to me like that's not going to go down very well in the oil markets, and that could actually result in a bid underlying oil prices right when stockpiles are diesel stockpiles in the US are the lowest since the 80s.
I mean, this is 100% a political move heading into the election cycle here. I mean, it is what it is. They're trying to get gas prices off people's minds. We've seen them tick up a little bit over the last couple of weeks. Obviously, they're down from the highs of the summer. I mean, it is what it is. It's not a good economic move. It's not a smart strategic move, but it's a way to continue to have the reins. I mean, this is what we deal with. Unfortunately, in the democracy, is whoever has power is going to use it to curry favor for themselves. I mean, I don't think it would be the other way around if it was a different party. It's just the way of the world.
Do you think that we have a chance of replenishing the stockpiles to what they were in at least the near term?
No. I mean, I don't know. First of all, where would you get it? How would you do it without really limiting supply? I mean, you're going to have to hope there's going to be a day where we have another, big recessionary move a la 2020, where oil really takes a dive in order for it to be economically beneficial for the people. But, that doesn't seem to be the concern.
Yeah, I think right now they're focused on the shark closest to the boat, and they're trying not to think about what's going to happen in the future. Hence, I mean, that's why you saw President Biden, when he was interviewed on CNN, when asked about recession, say he doesn't expect a recession, even though these bank CEOs that we'll talk about right now all are expecting some caution and level of recession coming into the market.
Yeah, in fact, his exact quote was our economy is strong as hell.
I mean, I don't know. Yeah, I mean, I think if you actually take that literally, does that mean it's weak?
Yeah.
So I don't know. All right, continuing on with the bank earnings, we had Goldman Sachs this morning, which kind of wrapped up all of the bank results for the quarter. Interesting disparity between among all the banks. You had, on one hand, Bank of America is really executing the best, and they're saying we're just dealing with the market that's in front of us. They're getting the most loan growth. They're actually having decent deposit growth as well. Meanwhile, JP Morgan is retrenching. Definitely the most conservative right now, has the most capital on its balance sheet other than Goldman Sachs, but Goldman Sachs is a little bit odd. And not writing nearly as many loans. Wells Fargo actually had decent loan growth, but the problem with Wells Fargo is that they're all C&I loans. So the net interest income looks awesome right now because a lot of those C&I loans, commercial and industrial loans, float. So their interest yield on assets, because a commercial entity's loan is a bank's asset. So the interest on yield on assets for Wells Fargo for those loans is up almost 170 basis points over last year, whereas the average loan is only up 80 to 90 basis points. So Wells Fargo is actually performing okay for now, but with that, you have higher credit risk, you have more concentration risk. And I think Wells Fargo skated away with this quarter, but if the economy deteriorates, I think that they're in a really tough spot. Citigroup is just terrible. They're trying to become smaller, but really what they're doing is just losing deposits. Their fixed income trading was terrible. I know that's something that you've talked about for a while, saying this is the last bastion of Citigroup. It's the fixed income business. Well, I mean, that only grew 1% on a year-over-year basis. In contrast, JP Morgan was up 22, Bank of America was up 27, and Goldman was up 41.
Yeah.
So Citi was absolutely abysmal there. And shifting gears to Goldman, I think that they just continue to crush it on the transactional business. They are doing that split into the three segments that we talked about yesterday. They only reported about an hour ago, so I haven't done a deep dive into that quarter yet, but they are being conservative. They have a capital of 14.3% on their balance sheet, which compares to Citi of 12.2 and Wells Fargo of 10.3. JP Morgan is 12.5, but it's a little bit more stable of a business, so you can have a little bit lower capital there. Tom, any thoughts on the banks?
I mean, the big one is that they're just getting crushed on deals, whether it be, I mean, it seems like, M&A or IPOs or new issuance of bonds, like everybody's taking a cut in terms of deal activity. I mean, there's a big article on Bloomberg this morning saying that there's a 36% drop in revenue from deals this year, and that personnel changes are probably going to have to be on the table. We talked about it yesterday, Goldman Sachs consolidating, different silos of banking in order to kind of encompass that. But you can see who the winners are. I mean, the operators are the ones who've turned into, and said, hey, where can we make money in this market? Well, volatility lends itself to making money on the trading side in secondary markets on fixed income, and so the winners have been, Goldman Sachs at 41%. And we've basically been building into that position with that in mind, being that they're best in class. And Citigroup, who traditionally is a major player in there, obviously taking a big stumble. I don't know what else they have, to your point. I mean, Citigroup, the one thing you can say is that they're very, very beaten up, and there was a possibility for them to come in over the top with great trading revenue and surprise and maybe have a double-digit update, but that's just, they didn't do it. They couldn't execute, which is not a surprise. I mean, between Wells Fargo and Citi, you really have your pick as to who's the worst investment bank on the street.
Citigroup is fast becoming, and they're not Credit Suisse, not by a long shot right now, but they are becoming a little bit of a pariah. No one really wants to use them. Their investment bank was down 64%, dramatically underperformed expectations by about 30 points. And 64 sounds like a lot, and it is. JP Morgan and Bank of America were in the mid 40s. Goldman was down 57, but Goldman was also had a very tough comparison period from last quarter. But Citi just can't get a win anywhere, and their expenses are up. So their revenue is down, expenses are up. By contrast, Bank of America, which has been the best operator so far this year in terms of capitalizing on the environment, their revenue is up 23% and their expenses are flat. So good for Bank of America. JP Morgan, also like we said, conservative. Their revenue was actually up 38% as they just moved through old vintages of loans. Expenses, though, were up 8% for the year. So that's what we have on the banks. This morning, we have Johnson & Johnson and Lockheed Martin reporting earnings. Johnson & Johnson was a little bit disappointing. That's primarily because of foreign currency. They also have this drug called Stelara for Crohn's disease, and that underperformed expectations, but that's going off patent next year. So no one really cares about that business because they figure that's going away anyway. So Johnson & Johnson, just kind of a humdrum quarter, nothing really exciting about that. They are going to be spinning off that consumer health business as previously announced in the second half of next year. Lockheed Martin, I was disappointed by this quarter. What they're doing is they're not actually seeing any revenue growth for next year, which is a bit of a disappointment relative to expectations. The Wall Street was looking for 3% revenue growth. They're going to come in flat. They're going to see some margin deterioration next year as well. On the flip side, though, they do have some cash flow and they are levering up. They're buying back a ton of stock. So they're going to add debt. They're going to take out debt, buy back stock, and hope that when the market turns, maybe in 2024, 2025, as some of these recent orders come through, that they'll be primed for success. So that's Lockheed's strategy. Is a bit of a risky strategy, especially with debt costs where they are now. I don't know what your thoughts are, Tom. I think that management has been a bit weak since Jim Takelet arrived, but I guess we'll have to see. Maybe he'll have the last laugh on this.
I mean, this is perhaps a problematic statement, but one of the things we looked at when we pitched Lockheed Martin was we were looking at the CEO, and he's got a little bit of a Jack Sprat situation. If you look at the old nursery rhyme Jack Sprat, one of the things when James Franklin took over the University of or Vanderbilt as the coach, everyone was like, "Man, this guy can recruit," based on his home life. And so I think that's one takeaway. This guy is very odd, not a big fan. I don't own a ton of Lockheed. I've been curtailing it significantly over the last, couple months or so. So our exposure is not big, but I don't have a lot of faith in the management team. If you'd like to talk offline about exactly what that means, I'd be happy to talk to you about it, but perhaps the podcast is not the best place or best venue to do so.
I would concur. I think that's a good pause there. Tonight we have JB Hunt, Netflix, and Adobe. JB Hunt is probably the most interesting to me, although Netflix will be definitely the most interesting to CNBC after they've posted 2 consecutive quarters of subscriber declines. It'll be interesting to see if they can stem that tide. And then Adobe has a big conference tonight, kind of reassessing where they are and their investors, and it's their capital markets day. So that'll be something that we're watching as well. But stepping back a little bit, when we talk about the market right now, because we had bank earnings that were fine, but people are nervous. Johnson & Johnson, that was fine. People are nervous. Lockheed Martin's not seeing any growth next year. But the market has rallied strongly the last few days. And I'm curious, Tom, as to why you think that's the case. I have my opinions and I'll go after you.
I think it's a combination of things. I think one is we've just been in the sell anything market. And so, we've seen just tons and tons and tons and tons of shorts pile in. People are not excited. People are taking big negative stances on the market. And I think that's sort of oversold everything. I think the pressure to the downside is very, very, very extreme. So any little spark of upside is going to end up with pushing people out of those short positions because a little bit of uptick is going to scare you out. On top of that, I think the big narrative people are saying is that there's been the big pivot in the UK. I don't think that really is going to amount to much. But again, the little bit of spark of optimism, I think, is what's really driving that. So like one kind of begets the other, if that makes sense. And then, I think people are starting to settle in as well on this rate situation. I think that it's becoming less and less, oh my God, they're going to raise interest rates. They've already done it. We're all still here. They're going to keep doing it. And the magnitude to which each hike affects the market is going to be less and less over time. as we settle in. So those are kind of the big pieces I'm thinking in terms of stylistically.
I agree. I mean, I think you can sum it up as pivots. And then also I would add on top of that, the layering of earnings, which are coming in well. I mean, we talked about Q3. I mean, you're looking at 2% plus GDP. Maybe we'll even have a 3% GDP quarter. Who knows? Does this fit the Fed's narrative? No. But for these couple of weeks, that doesn't matter. And what does matter is how offsides retail investors are. We talked about yesterday about 3 puts for every call option that was purchased last week. So people are extremely offside. They're betting against the market. Usually you'd always expect some level of expectation that people want to own the market over time, but people are actively betting against it. You have cash levels that are essentially at record levels, highest since April 2001. And you have equities that are underweight by 3 standard deviations. So think of it as if you had 1,000 days. This would be a 3-day event of how underweight fund managers are of equity. So they don't own equities, they have a bunch of cash, and retail investors are incredibly short, which could really create a big short squeeze during this earnings season, at least until we get the next inflation report in November. So that would be my view. And I think that's what's underlying this market rally today. I mean, you have the market up another close to 2% today. Even Meta's up 2% after getting the crackdown from the UK watchdog. So it's a generous market for now, and that's how we're understanding things. So the timing on trims is going to be important, and we're going to be watching that like a hawk. So with that, have a great rest of the day, and we will connect with you tomorrow morning.